Hey traders, welcome back. If you're just getting started and you've heard terms like supply zones, demand zones, or institutional levels, but you don't know how to find them or how to use them in your trades, this video is for you. By the end of this video, you'll understand exactly what institutional supply and demand zones are, how to spot them on your charts, and how to use them to trade with zero indicators and 100% clarity. Let's break it down step by step. What are institutional supply and demand zones? First things first. What do we mean by supply and demand zones? These are price areas on the chart where large orders have been placed by big players, like institutions, hedge funds, or banks. These areas cause big moves in price. Demand zone is the area where smart money buys heavily and price moves upward. Supply zone is the area where smart money sells heavily and price drops. When price returns to these zones later, it often reacts again, because unfilled institutional orders might still be sitting there. Think of it like a footprint of big traders. They left something behind. You can use these zones to catch powerful entries in line with smart money activity. Why should you care? Most retail traders chase price. They trade random patterns and indicators. But smart traders focus on where price moved away strongly, because that shows where institutions were active. You're not trying to predict the market. You're trying to follow the smart money. How do you find these zones? Step 1. Spot a strong impulsive move. The very first thing to do is spot a strong impulsive move. This is a candle or a group of candles that move with high momentum, breaking previous structure, leaving imbalance, or shifting character. For demand, look for big bullish candles that break above previous highs or resistance. For supply, look for large bearish candles that break previous lows or support. Now go back and ask, where did that move start from? That's your potential institutional zone. Step 2. Mark the origin zone. Once you find the impulse move, find the last candle that moved in the opposite direction. For demand zones, mark the last bearish candle before the strong bullish move. For supply zones, mark the last bullish candle before the strong bearish drop. Use the open and low of the bearish candle for demand zones. Use the open and high of the bullish candle for supply zones. This candle is your institutional footprint. Step 3. Wait for price to return to that zone. Now be patient. Let price return to the zone you've marked. This is where many traders go wrong. They try to enter too early or chase the move. Instead, wait for confirmation. Step 4. Look for reaction and confirmation. When price comes back to your zone, don't blindly enter. You want to look for clues that price is respecting the zone. Do you see a rejection wick? Is there a change of character on the lower time frame? Did price sweep liquidity and then reverse? These are your confirmation signals. Once you get confirmation, you enter with confidence, using a small stop loss below or above the zone and targeting the next structural level. Let's go through realistic chart examples. Example 1. Bullish demand zone. Entry price was consolidating in a small range on the 15-minute chart. Then, a strong bullish candle breaks above the range high, taking out liquidity. You go back and mark the last bearish candle before that breakout. That becomes your demand zone. 2 hours later, price returns to that exact candle zone, creates a small wick down, then quickly pushes up. On the 1-minute time frame, you also see a small change of character. Price breaks a previous lower high. That's your entry signal. You enter long at the zone, stop below the wick, and target the next high. This is how smart money catches sniper entries. Example 2. Bearish supply zone. Entry price is in a clear downtrend on the 1-hour chart. It makes lower lows and lower highs. Suddenly, there's a pullback with a strong green candle. But the next candle is a huge red candle that breaks back below structure. You go back and mark the last green candle before the drop. That's your supply zone. Later, price returns to that zone and prints a rejection wick, then forms a bearish change of character on the 5-minute chart. You enter short at the zone with stop above the high. This trade runs perfectly down to the next support. Example 3, failed demand zone. Let's look at a failed setup. Price creates a strong bullish move from a 5-minute demand zone. You mark the zone, price comes back, but this time it breaks straight through. What happened? Check the higher time frame. Maybe the daily chart was in a downtrend. Maybe there was no confirmation this time, no change of character or rejection wick. This teaches you that not every zone works, but confirmation filters out most bad ones. How to refine your zones. There are 2 ways traders mark zones: body to wick or body to body. Wick method. Use the high and low of the candle for wide protection, better for beginners. Body method. Use the open and close for tighter zones, great for experienced traders with precision entries. Whichever you choose, backtest and stay consistent. Full entry checklist. Here's a step-by-step checklist you can follow. 1. Spot an impulsive move with strong momentum. 2. Mark the last opposite candle before that move. 3. Draw your zone from open to wick or body to body. 4. Wait for price to return. 5. Look for reaction, wick, rejection or pattern. 6. Wait for a change of character or structure shift. 7. Enter on confirmation. 8. Place stop beyond the zone, wick. 9. Target next liquidity pool or structure level. 10. Journal the trade, win or loss, to build experience. How to practice if you're a complete beginner. If this feels overwhelming, here's how to start. Open a clean TradingView chart. Hide all indicators. Go to the 15-minute or 1-hour time frame. Scroll back and spot where big candles created movement. Mark the last candle before the move. Check how price reacted when it came back. Do this for 20 to 30 examples. This will train your eyes to see what institutions see. Zone versus support and resistance. What's the difference? Many traders confuse zones with basic support and resistance. Support and resistance is usually a flat line. Zones are entire price ranges, drawn from actual candles and based on smart money activity. Support breaks easily, but institutional demand zones have purpose behind them. That's why they work better. Frequently asked questions. Question: do supply and demand zones work on all time frames? Answer: yes, but higher time frames give stronger zones. Use smaller time frames for precise entries. Question: can I enter as soon as price hits the zone? Answer: you can, but it's risky. Always wait for reaction or confirmation. Question: what if my zone fails? Answer: losses happen. That's why you use stop losses and risk management. Don't marry a zone. Question: what pairs does this work on? Answer: it works on Forex, crypto, indices, and even stocks, because institutions are everywhere. Recap: institutional supply and demand zones in simple steps. 1. Understand that zones come from smart money. Moves. 2. Spot strong impulses. With structure breaks. 3. Find the origin candle and mark it as your zone. 4. Wait for price to come back. 5. Look for confirmation like change of character or liquidity. Sweep. 6. Execute with proper stop loss and risk to reward. 7. Combine it with higher time frame bias for higher accuracy. 8. Practice again and again. Screen time builds skill. Thanks for watching. If you want the next video on fair value gaps, change of character, or entry techniques using order blocks and liquidity, drop a comment below. And don't forget to subscribe. More smart money education is coming soon.